Hi, Stephen. Good afternoon. Hope you're doing well. I'll quickly go through the portfolio synopsis and recommendation on the second project, investment project that you have provided. The client objective is to a client is risk averse and requires a return of around 15% and not lose 10%, not more than 10% on the portfolio. This particular table gives a synopsis of the portfolio in a tabular form and the weightages uh, in a weightage in the portfolio for these various investments. Uh, this is the recommendation in a tabular form that I have provided. To provide a commentary on the current portfolio. So the first investment is Resources and Energy Group stock, which is Australian's traded stock with negative net income, and allocation seems to be high in the portfolio of around 10%. Uh, the stock may go down further considering the fundamentals of the company, so I think it's not suitable for clients' portfolio. The second investment is ProShares Dow Jones 30, which is an ETF with underlying as Dow Jones Industrial Average. It seeks to protect and profit from market declines. Although the goal is worth pursuing, but uh, from the perspective of the allocation and the cost, I think this particular investment has given negative returns historically and may not be suitable for the client. Uh, Downside protection can be provided at much lower cost through different investment avenues at much lower cost. Egyptian government bonds allocation of 50% seems to be high, very concentrated. It's a high, although the yield is high. Uh, the rating of B is non-investment grade, and there is significant risk of capital loss if the bond defaults. So, in terms of reducing risk, I think this is not suitable for the portfolio. Allocation to cash of around 20% is high, although it reduces risk and provides increased liquidity. Unless the client has any short-term commitments, I think this cash can be utilized for um, investment to enhance return for the portfolio. The fifth investment is Tesla stock. Although this stock has performed really well, but that's the company fundamentally does not have a proven track record. Although it, the company is in its investment phase and may provide good returns in the future, but from the portfolio's perspective, I think there's a concentration of 10% of the portfolio on this stock and may not be suitable for the client. So overall, in summary, the portfolio is volatile and less diversified. Considering the stated objective of the client, the portfolio in its current form may not be suitable for the client. Now, let me walk you through the proposed portfolio. It just gives a synopsis in a tabular form. The overall portfolio, proposed portfolio, will give a return of around 10.10%, and standard deviation of the portfolio would be around 12.9%. Although, uh, based on the client's objective, this may not seem to meet, but then there is uh, returns can be enhanced and the downside can be protected to less than 10% by buying portfolio insurance, which I will elaborate shortly. So the first investment is Bloomberg Barclays US Aggregate Index. This provides safety of capital with diversification reduces the risk to the portfolio at low cost. Same is done by Bloomberg Barclays Emerging Market Local Bond um, Fund, which gives exposure to emerging market bonds at much low cost. The major investment that I have recommended is S&P 500 index. This will enhance return for the client. It's an index of the most diversified U.S. stocks. Um, Provides high return without compromising much on the risk to the portfolio. Uh, Cash at 5% will provide liquidity if the client has any short-term commitment, and also would be utilized to buying portfolio insurance. What do I mean by portfolio insurance? Um, so as I mentioned, the portfolio does not uh, fully meet the requirements of the client, but this particular strategy of investing in a derivative strategy of investing in out of the money puts on S&P 500 index would give downside protection to the portfolio and also enhance return when the uh, puts uh, when the puts are in the money. It's a low cost convex strategy which reduces risk and enhances return. So in summary, overall, although the return of 15%, considering the constraint on the portfolio, we may not be able to achieve consistently, for which we need to sensitize the client. But overall, the proposed portfolio achieves client objective of reducing risk and enhancing return. That's my recommendation. Um, Thank you for listening, and you have a good day. Thank you.